All right, guys, welcome to our Market Insights presentation. Is your portfolio panic proof? Today is April 22nd, and we have a lot to cover today, so let's dig right in. Uh, if you're not familiar with who I am, my name is David Zarling. I'm one of the partners, and I'm the head of investment strategy and research at Client First Tax and Wealth Advisors. We are in charge of running the Adaptiv Investment Management System for our clients. Normally we do these presentations in addition to doing a YouTube video. We also do these in person normally. It's part of our Lunch and Learn education series, which we do monthly, which you can find online here at the web address highlighted. It's a great time. We like to be in person, enjoying a good meal or maybe some beverages in the evening together. Quite a few people attend, and quite a few people view these videos. But due to the safer home orders and the COVID situation we're under now, we're just providing this video to you. Hopefully you find it useful, and I'm really looking forward to when we can meet in person again. But in the meantime, we can use technology to our advantage and do a video such as this and provide the same type of in-depth information that you can use to hopefully provide some insights to your day. As always, these presentations are for informational purposes, educational purposes, and by no means should they be relied upon as a basis for investment decisions. You can get our full legal restrictions in terms of use on our website. And let's go ahead and jump into what our agenda is going to be today, because we have a lot to cover. I'm going to throw a lot at you guys in a short amount of time frame. One of the great things about this is you can pause, walk away from the video. You can have this with your favorite beer, beverage, Manhattan, old fashioned, you name it. Maybe you're going to watch in the morning and you're going to have some coffee, maybe some tea. But the beauty of that is you can be watching this on your phone, and we're going to jump into this agenda here. First thing we're going to cover is the COVID correction that we've currently been under. Definitely one for the history books. We're also going to talk about, is there a math problem with buy and hold investing? We're going to talk about how Adaptiv has navigated these types of markets. We're going to talk about, is the COVID correction over, or is there more to come? We'll also go through some questions that were submitted to us online, which I really appreciate you guys doing. Some came via email, some came via the website, and so we'll try to go over those as best as we can. And then we'll finish up with some housekeeping and final thoughts. But again, there's a lot of slides here, a lot of different information, so we're going to go through it quickly, but feel free to reach out to us via my team at clientfirsttaxandwealth.com, and I'll be able to address any questions you have after this presentation, and let's jump into it. So obviously the first quarter of 2020 was one of the most significant panic type environments that we've seen in the marketplace in quite some time. To drive that point home, you can see here this current period, the February to March 2020 sell-off was the fastest 30% drawdown in history. You have some familiar periods here that you've seen in the past before. And, whether it's during the dot-com bust or previous periods there, 1987 might be another period that you're familiar with. Obviously, I'm struggling with my slides here, but let's try to get through that. Whether we're looking at 1987, 2002, 2007, these are all familiar periods to you that you from the past. And February, March 2020 was faster than any of those periods. In fact, the prior fastest periods were, 1934, 1931, 1929. That kind of gives you an idea of the speed of this type of sell-off. Just to kind of give you some comparative or, perspective on this type of correction, what I have in front of us here is the S&P 500. And what I want to look at is I want to compare the S&P 500 correction that took place in late 2018 versus the correction that took place just recently. And what I have highlighted in the orange boxes here, that is about 20%. The correction in 2018 is 20%. This move in February into March was 20%, this original box here. Obviously, the market fell much further, but that gives you an idea of what 20% looks like and the time frame that it took. Another way to view that information would be something like this, which shows that the S&P 500 in 2018 took about 65 trading days to drop 20%, whereas this most recent correction took about 14 days. So that gives you an idea of the veracity of this type of correction. We can also look at it and compare it to other corrections. So what the S&P 500 looked like in red is obviously the current correction that just took place versus all the other various bear markets. Whether we're talking about something from the 70s, something during the 2000s, back in the 1920s, 30s. There's been plenty of bear markets that take place, and this gives you an idea of what this current panic looked like. And I think it really drives home the point of just how quick and how fast and how record-setting it was. This, again, is the S&P 500. Here we can see the 23 trading days overall that the market dropped from about February 19th to March 23rd is about 23 trading days. The market dropped 35%. What's important to note about that is how drawdowns versus the percent return needed to get back to even. This is a very important concept to drive home. For example, losing or having the market fall 35% puts us in the territory about here. That means the market has to return about 54% to get back to even, just to get back to even. Comparatively, during that same period of time, our most aggressive portfolios, our ultra growth and growth models, dropped about 14 to 18% during this exact same period of time. And so using a number like 14% drawdown, right here, that's about a 17% return to get back to even. That's quite a difference. Having to return 17% to get back to even is quite a difference between that and 53% to get back to even, or even something around 11%, which falls around here. That takes about a little over that. So it's going to take 12-something% to get back to even, which is much different than 53%. So 35% move in 23 trading days. That's very fast. And the Adaptiv System was able to adapt and protect during that drawdown, obviously not eliminating negative returns, but definitely muting them during that period of time. Russell 2000 is another one that this represents 2,000 of the United States smallest cap weighted stocks. And this dropped minus 43% in 23 trading days. If you think about that, that's quite a significant move that falls somewhere in here. So, we're talking about some type of 70% return just to get back to even. That is dramatic compared to the cushioning that was done with Adaptiv during that same period of time. And so quite a bit of damage was done to stocks, not only in the U.S., but internationally, and we'll get to that. But also bonds. Many people view bonds as being a safe haven, a place where people can protect assets and generate some type of income. Many portfolios are set up to own some portion of stocks, some portion of bonds, with the thinking that you're taking on some type of risk with stocks, which you are, but that it's offset by what would be considered reduced risk in bonds. Many times that's actually the case, but not always. There are definitely market environments where bonds correct. And so here you have the safest of the safest, this is being represented by the ETF AGG, if you're following along at home, and this is aggregate bonds. So this should be the one of the most conservative parts of the portfolio, dropping 11% in 9 trading days. And so very important to note that bonds were not safe during this correction at all. And again, for those of you who are familiar with my presentations, from time to time, I tend to harp on the media because I believe they don't have our best interest in mind when it comes to financial information. They tend to be very reactive or responsive, meaning, responding to the price action rather than having a game plan going to the price action. And a lot of it is driven by, how many viewers can we have, how many clicks can we have, etc. And here's two really smart individuals. I have no, I'm not putting this video here and putting these individuals on the screen to somehow say that we are or I am smarter than Bill Ackman or Ray Dalio. That's probably quite the opposite. But you have very smart individuals such as Ray Dalio saying up in here near the highs that, cash is trash. And you have someone as smart as Bill Ackman saying hell is coming, and this is taking place near a bottom in stocks at the end of March. So very hard to use TV like CNBC. A lot of great individuals on there with very smart insight. I don't want to slam them too hard, but it's very hard to use. Just know what you're consuming. If you're consuming financial media, whether it's online or on TV, just be wary that they're not going to know your specific individual needs. They're not operating in your best interest, and it's very hard to use that information in your investment process. And that's why we don't. CNBC is not on in our office. We don't listen to financial news. We're purely focused on the data, and we'll get into that in a little bit. Driving further home the veracity of this type of correction. These are all the different types of corrections that we've seen in the past. I know that the Adaptiv team, myself with Ian McMillan and Kevin Ferrari, we had discussions as this was unfolding. Was this our 1987? And it in fact did turn out to be such an event. 1987 here in green. This gives you an idea of what the 1987 correction took about just over 37 trading days to correct as far as it did, a little less than 35%. These areas here kind of give you an idea of what other corrections look like to get to minus 20%. Some of you might be familiar with the Great Financial Crisis or the housing crisis, which took place 07, 08, 09. That correction is in this time frame here. To get even to minus 20%, we were at minus 20% very quickly in this environment. It's shy of 19 trading days. I don't know the exact amount, but 1929 is another very famous period that people are familiar with. And here we are, 2020, minus 35% in about 23 trading days. So this drives home just how quickly this correction took place that in going into March 23rd. And it's important to note that because we want to know how to do different investment processes and systems work in such a corrective environment. So how does Adaptiv work in such an environment like this? And so we'll get into that a little bit. Equal to the quickness with which the market corrected was, I understand that, for some people, they may not be a fan of Congress or the president or any of those things. I understand it. All the criticisms are valid, or most criticisms are valid. But one thing I will say is the quickness with which they responded to the panic and crisis. On the right-hand side over here, this represents the response time and amount for the Great Financial Crisis. Not that overall dollar amount matters, but it's about $790 billion. And it took over 500 days to respond with the total package. Now, what's interesting is that our leaders were able to respond in a very short amount of time to the needs at hand. And that may have stifled or helped mute, believe it or not, a minus 35% correction to keep it at that. Time will tell whether we're going to have lower lows on our hands. But interestingly, they almost acted as if they knew it was coming. I don't want to get into any more detail than that, but I will say they responded quickly. 11 weeks after coronavirus outbreak, that they've got a bill passed is pretty doggone impressive. So not only was the correction quick, but some of the reaction by our leadership was also quick. As far as volatility goes, obviously with a move of minus 35% in that quick of a time, obviously volatility was very high. This chart here is from Bespoke. This shows the average daily percentage change. So you think about each day that takes place, a Monday, a Tuesday, a Wednesday, a Thursday, all the different trading days. What was the average daily percentage change? And then what did that look like during the month? March was incredible. March in 2020 had a 4.8 average daily range. There are some years in the S&P 500 that don't have a return of 4.8%. This is right up there with the great financial crisis in '08. It's right up there with the great crash of 1987. It's right up there with the Great Depression in 1929, 1932. So very impressive intraday daily price changes in the market. Highlighting that even further, this is a chart showing the market's total return. That's what's in yellow is the S&P 500. The blue lines here are showing the elevation or the height of implied volatility. So, for example, on Black Monday, the VIX, or a recreation of the VIX, the total monthly volatility, is measuring approximately here, above 80%. Here we have the Great Crash in 1929, above 80%. We have the Great Financial Crisis, which reached about that level, and here we have the COVID panic. And so you have these very important events from the past, and this just goes to show just how tremendous the volatility was during this period, and it remains so. In fact, 2020 is currently tied for 6th most volatile year, and we are not even through the year yet. This is a chart from Macro Charts, who provides great information on Twitter. You can follow him there. What's interesting is that we're only here in time. We're only at this point in time, and we're already tied for 6th most volatile year. And so it doesn't have to continue this way. It doesn't have, volatility can cool off, but we're definitely in a situation where VIX is near 40 or has been above it. And so that's something that continues to, if you want to use the term, plague the market, and something that we have to navigate as market participants. Kind of showing this in a different way, as far as we talked about those intraday ranges. These are different days during the correction. This doesn't actually go through March 23rd, which is the most recent bottom. This is the beginning of the collapse, crash, panic, whatever you want to call it. And we've got days in here that are 3 and 4%. Big days like this, minus 4.4%, and that's just during the day. That's from a point like this to a point like this, minus 4.4%. Or you have other days like this that are from an open to a close that are 4.6%. Again, that is incredible movement. Sometimes we don't even get months or years in the S&P 500 with that type of return. The other thing I'd like to point out is, for example, using a date like this one here, this is the close of that day, and this is the open of the next day. So this is what happened overnight in this area. So this means a gap down overnight. And so not only did we have intraday volatility, but we also had overnight, tremendous volatility in the overnight. That's what this chart here shows. And this is another chart from Macro Charts. And really what this is in green is if you just held the S&P 500 using an ETF like SPY, and you just held it overnight. Okay, very important to highlight this. In green, look at what your performance would be. So you didn't hold during the day. Now this isn't actually necessarily easily done or possible to do. But if you just held overnight, this is what your cumulative returns would look like since 1993. That's in green. In red is if you just held during the day. And so that gives you the significance of what it means to hold overnight, that a lot of returns happen overnight. However, during the correction, overnight was not immune to corrective measures. Here we see that just holding overnight, by March 19th, that's not even the bottom, if you had just held the overnight, is minus 29%, which actually exceeds the correction. So if you just held overnight during the great financial crisis, that would have been minus 28%. So overnight volatility was greater than, and probably even greater than '03 during the dot-com bust, but greater than the great financial crisis. So daily intraday volatility was tremendous. Overnight volatility was tremendous. One for the record books for sure. Giving you a little bit of more context on this. Here's the S&P 500. Here's March 23rd. We have a corrective move that basically wipes out 3 years of gains. Here's about the election over here, election night 2016. 3 years of gains wiped out in 23 days in the S&P 500. And the S&P 500, one of the best performing indexes on the planet during this correction. Dow Jones wiped out 3 years of gains in 23 days. Again, election takes place about here, but that gives you an idea. It even wiped out the Christmas lows from 2018. That's important. But 3 years of gains wiped out in a very short amount of time. Russell 2000, this one was even more dramatic. 7 years of gains. So you're basically at the same price level as you were back in the first half of 2013. So if you think about that, that's pretty incredible. 7 years of gains wiped out in 23 days in the Russell 2000. This is the All World Index. This contains, about 8,000 constituents, does a really good job indicating what's going on with stocks all over the world, including the U.S. 4 years of gains wiped out in 23 days. So we were as low as we were back at the beginning of 2016. Pretty incredible. This is the All World Index. So it's all stocks and then minus taking out the United States stocks to get rid of that U.S. bias, if you will. Man, 10 years of gains wiped out in 23 days. Very impressive. Same price level it was back in 2010. Very impressive amount of damage done. And that brings, us to corporate bonds. As an example, corporate bonds are supposed to be some of the most liquid, and if you want to call them, I don't want to call them risk-free because they're by no means risk-free, but really not meant to be moving at the same velocity as stocks. And here we have corporate bonds, and that's one of the stories of this correction is some of the corporate debt that was under assault during this time. We had 10 years of gains wiped out in 23 days. So the same price on corporate bonds, I'm using the ETF LQD here, the same prices we saw back in 2010. I think you're getting the point here. Here's oil, and this is a chart that's actually from recent days here, and it actually shows, believe it or not, oil. This chart doesn't show it, but oil actually went negative in the May contract for futures, and we'll get into that future in the presentation. But current prices, hovering anywhere from $10 to $15, and that's the same price we had back in 1999. 20 years of oil gains wiped out in 23 days. In fact, as I mentioned, May oil futures traded negative, which was the first time in history. Again, I'll cover that later on in the presentation. But this drives home this rapid panic type corrections that can take place in markets. So the next thing I wanted to jump to is some of our industry, in fact, the majority of our industry believes that buy and hold investing is the best method. And really, we couldn't disagree more as investment managers using the Adaptiv System. Now, we don't disagree that being through corrective markets in your 20s and 30s and dollar cost averaging can be beneficial. However, as you're near and enter retirement, to have these 30, 40, 50% corrections that take place in the market rather frequently is not a tenable way to manage your retirement. And so I kind of wanted to highlight the math problem with buy and hold investing, because really it only works if two things: you hold the whole time, and two, that the market bounces back, and it bounces back in a timely enough a manner that you can use it for your retirement. And so driving that home a little bit is that table we talked about before. We start having periods where we're having 30, 40, 50% corrections. And now we're talking about our account being cut, in half or a third, and it's taking, 43% to get back to even, or, over 50% to get back to even, or, 100% to get back to even. The reason why we use adaptive is we don't need to be in scenarios when we're nearing in retirement where we're having to get 100% return just to get back to even. What do I mean by that? Using the S&P 500 again, this chart goes back to the late 90s, but these were corrective periods, right? In the dot-com bust, from the tops in 2000 to the bottoms here was about minus 46%. So a $500,000 account is about $270,000. That took about 3 years to unfold. It took about 5 years to recover that just to get back to even, which took about an 85% return to get back to even. 0809 takes place in about 18 months. A $500,000 account balance is now 215 minus 57%, and it takes up till 2013 to get back to even, and 132%. So this period here, if you think about it, this straight line that runs across here, straighter than what I can draw, that's a market that went nowhere for 13 years. Maybe you could argue went everywhere, it went everywhere but nowhere. A lot of heartburn in between. And so while this might be okay to dollar cost average in when you're in 20s and 30s, it's not okay. It's not in your best interest when you're near in retirement to have these type of haircuts to your account, because how do you have a bona fide retirement plan with that? And so that's why we use the adaptive system. Driving that home again, using the example that just took place, a $500,000 account that would have been exposed to the brunt of this full correction would have been worth about $325 minus 35%, which would take 53% just to get back to even. So very important that we identify that there is a mathematical issue with buying and holding, especially as in the later years as you near or in retirement. Now, one of the things that we often hear in the marketplace for those who are proponents of buy and hold is, well, if you're not buying and holding, you're going to miss the best days in the market. As if that's a scary thing if we miss the best days in the market. Well, what does that look like? What happens if we do miss the best days in the market? What does that look like? So let's do a little study, right? Because we're focused on the data. We're not just focused on mantras. So this is data that we put together and pulled from Dorsey, Wright and Associates, which is a very nice partner of ours that we work with and appreciate. And what this shows is the best and worst performing days. And this is the Dow Jones 20 best and 20 worst days since 1984. And it goes through 10/18/2017 when this research was done. That's the anniversary of the 1987 crash. That's why it was put together. That's why that date's significant. And what we'll notice from this chart is that some of the best and worst days are clustered together. They are actually next to each other, sometimes days and sometimes weeks apart. And so this is a really important diagnosis, is we can't just take the best days in a vacuum. So what this research shows is if we look at buy and hold of the Dow Jones from 12/31/1984 to the anniversary of that crash in 1987 on 10/18/2017, so about 32 years, if you had done buy and hold, you would have had a return of about 1,800%. So just buy and hold, return of 1,800%. If you had missed the best days, your return would only have been 484%. So the statement, if you miss the best days, your returns will go down, is a half truth. And I hate half truths. So let's look on the other side. What if we just missed the 20 worst days? Well, our return would have been about 8,500%. So if we missed the 20 worst days in that time frame, our return's 8,500%, which is way greater, obviously, than 1,800%. Now, what does this look like if we miss the best and worst days, which we know tend to cluster together? So buy and hold, 32-year period, your return is about 1,800%. If you miss the best and worst 20 days, your hypothetical portfolio return would be about 2,600%. So you'd be outperforming buy and hold by almost 800%. That's $800,000 on a $100,000 initial investment. Now, this is done for illustrative purposes only, but this is driving home the fact that saying you're going to miss the best days is a fallacy that we need to ignore when we think about proper investment management and doing what's in the best interest of our clients. Visualizing this on a chart, this is this period from the late 90s to about now, and in red are the 25 best days in the market. So the red dots represent where the 25 best days happened, and what you'll notice is that the best days tend to happen in the worst markets. So these best days, there's one here, but the rest of them are happening in a market that's falling. Another market where a bunch of best days happen was this market here, when the market's falling. These best days also happened in a market that's falling. Okay, and more, even recently, we had several best days, quote unquote, best days during this correction, but they're all happening in a worst market. So we don't need to adhere to the old adage that we'd be missing out on the best days, because when you're missing out on the best days, you're also missing out on the worst days. Very important to remember. So another thing with buy and hold investing that may become self-evident to you as we went through some of those charts is the fact that not all markets are the same. Just like driving conditions are not all the same. Sometimes we can set the cruise control on 70 miles per hour and head down the highway with no issue. But there's other times where we have to do mountain driving and where there's braking and shifting and different type of weather conditions that we have to account for. What do I mean by that? As an example, this is that all-world index with about 8,000 constituents to it, 8,000 stocks. It does a really good job representing what's going on in the marketplace overall with stocks globally. And what you'll notice is, there's a period here. You would agree with me that this period here is one type of market environment. This period here is another type of market environment. This is another type of market environment. And this most recent correction is another type of market environment. So we have uptrending markets. We have sideways and frustrating markets, such as we saw in 2018 and 2019. We have uptrending markets, such as 2017 or the October 2019 through the first part of 2020. And then we have panic type markets like we've seen recently. So what does an investment system look like that's able to navigate these different environments? Well, Adaptiv is one of those systems that is able to change based on what the market environment is. We'd like to say it adapts, right? So here is the same chart with the different market environments highlighted. So in green here, we have 2017. We have this uptrending market, very nice uptrending market. The total world index returns about plus 24%. During that same time frame, adaptive growth, our one of our models, returns about plus 23% after fees. This next environment here, from the beginning, about March 28th through late October 2019, is a sideways, frustrating market that basically goes nowhere and has almost a 20% correction. So in this pink box here, the total world had a 0% return. It went nowhere. and had a 19% drawdown. Adaptive growth during that same period of time had a little less return, minus 2.4%, but also during this period here did not have the same drawdown. Drawdown was cut in half. So less volatility, less drawdown, less risk to retirement accounts. Then we have a new environment here that starts in late October 2019. A different environment, an uptrending environment starts to take place. From this point here until the panic environment takes place, total world is up about 8%. Adaptive ultra growth is up about plus 15%. Adaptive growth is up plus 11% after fees. During this panic environment, from top until bottom, we have adaptive growth and adaptive ultra growth, minus 14 and minus 18. We don't like negative returns, but it's not minus 35% during that same period of time. So you have an adaptive system that can get market-like returns and sometimes greater, right? These periods here, greater returns in uptrends or equal to returns in uptrends, which dramatically reduced drawdowns in periods like this sideways period here that had a 19% drawdown, whereas adaptive growth only had 9.3, cutting it in half. Same thing here during this panic period, total world's down minus 35%, which, reminder, takes over 50% to get back to even, whereas these others are much more muted during this panic type period. So very important when you're reviewing and looking at what a system does is what's the market environment, point A. Point B, how does the system perform in that market environment? And this is very simple to show how well the adaptive system adjusts to different market environments, and that's very important for retirement accounts. So how do we do this? We use the adaptive system. We focus on the signal and we avoid the noise. Some of you are very familiar with this next segment. I'm going to roll through it quickly because there's a lot of information yet we have to go through, but this could give you a general idea of how we operate. The first thing we start with is price itself. Again, this is the S&P 500, and we can see supply and demand taking place, right? That's what price is the interaction of supply and demand. It's economic law. More selling than buying, and price drops. More buying than selling, and price rises. And this happens over and over in markets. And so we can use price as information, right? It's not something that gets restated. You know, there were a couple Chinese companies over the past couple months that actually lied on their earnings, and that's something that gets restated, right? Their earnings get restated, but the price chart does not. And so we can use price as fact in our investment process. The next thing we do is we identify trend. One of the tools that we use to identify trend, it's not the only tool, but one of the tools we use is a 40-week moving average. That's what's rolling through price right here in blue is the prior 40 weeks of information averaged. And so what that helps us do is identify, are we in an uptrend, right, which we want to be participating in, or are we in a downtrend, which we do not want to be participating in? We want to invest with uptrends and not with downtrends. So that's step one. That also helps us eliminate daily and weekly noise. You know, if you were to put your phone up to your face as you're watching this right now, or on your tablet or whatever you're watching it on, it'd be very hard to see what's going on. This helps us step back and see the big picture. Step two, this orange line that's running through here now is the prior 10 weeks of information average. So blue line, 40 weeks of information, orange line, 10 weeks of information. And what we know is that when orange is below blue, that's very important environmental information. That doesn't mean it's an automatic signal. We will use it for our purposes of identifying. For example, what we know is that when orange is below blue, that's when bad things tend to happen. Okay, it's very similar to saying when there's a snowstorm and we drive in it, that's when bad things tend to happen. So we can drive in a snowstorm, and that does not guarantee bad things to happen. We just know that the odds of bad things happening increase. And so we don't need to drive in the snowstorm. And so we simply make some simple rules that when orange is below blue, we're not going to participate. And when orange is above blue, we're going to participate. Driving the point home further again of the best days, you'll notice when orange is below blue, again, that's when some of these best days are taking place. are in these worse environments, these snowstorm type environments. And so we can use this as part of our process. We can use the orange and blue as part of our process to identify when is there too much risk, or when is there enough reward to warrant us being involved in markets. Because let's not mince words, right? Why are we involved in markets? I'm going to pause a little bit there because I want you to think about it. Are we in markets to have fun? Are we in markets to be right? Or are we in markets to make money because we need our accounts to outpace inflation so that we have enough money to live off of when we're in retirement, to pay for medical bills and other retirement expenses? So we're not in markets to have a friend. If we want a friend, we get a dog. So the reason why we actively manage and we adaptively manage is we do want to participate in uptrends. When there are uptrends taking place, we want to be a part of them, and we want to grow accounts. In the same fashion, when we're in corrective markets, we do not want to be a part of them because we know that having a minus 35% correction is a dubious prospect for a retirement account that now has to return 50% just to get back to even. So this is why we use the adaptive system. Very important. Buying and holding is not an option for our clients. It's not in the best interest of those entering retirement or in retirement. I would even argue it's not in the best, not the best idea for most individuals. But we can argue about that a different time. And if you're interested about that, you can reach out to us at my team at clientfirsttaxandwealth.com, and we'd be happy to discuss that with you. Now, jumping into, was this COVID correction, is it over or is it something bigger? And really where I want to go with this, because I know that's part of the reason why you're watching this video. And there's this thing about us, we have this human nature about desiring to know the future. We really want to know what's going to happen next. And it's a psychology thing, because we think if we somehow think we know what's going to happen next, that provides us calm and comfort, that it provides some form of certainty. And so sometimes we can get caught up in what is the future going to bring. And one of the hardest parts about investment management is many times we get asked by other industry professionals or even retail clients is, what's your projection? What do you think is going to happen? Where's that Dow going to end up? Where's the S&P 500 going to end up? Well, here's the honest answer. We don't know. And we wish more in our industry would answer that question with these three very important words: we don't know. The only other important words I can think of in the English, three important words I can think of in the English language are something like, I love you. We don't know is equally important. And so the fact that we don't know drives our investment process, because we don't need to get in an environment where we're marrying our biases, right? Because if we say, oh, we think the S&P 500 is going to finish at 3,500, that immediately implies some type of bias that we're entering our process with. So, and plus, really, anybody who does tell you that they do know or they think they know it is at worst lying and at best naive, because frankly, we don't know what tomorrow's going to bring. I can't tell you if the market's going to go up or down tomorrow. No one can. And so we need to have a bona fide process for handling uncertainty. And we don't handle uncertainty by claiming to know what's going to happen next. So in regards to COVID and the correction, and we've had a rebound or a rally since the bottom on March 24th. And some in the industry want to say, oh, we might have a retest of the lows. So the S&P 500 is going to go back to about 2,100. Or some say it's not. Some say it's going to move. We don't know. And so all we need to do is be focused on having a plan. And so I wanted to share this with you. I thought this picture was hilarious because, it has irony. The person is saying, I hate vandalism, which is what this is. And it has irony to it. And it's a list. And I would add number 4. Here are the things I hate. It might actually be number 1. I don't like predictions, because predictions, they don't help. They actually can hurt. And so we don't need to predict. We need to have a plan. And that's why we use the adaptive process. The adaptive process is not about predicting future events. We don't have crystal balls, but we do have ongoing game plans. And so I wanted to jump into some of that and just say, this is what we're doing on behalf of our clients to game plan for the future. So we're not predicting what the future is going to bring, but we're planning for it so that we have options for, if this happens, then we do this. If the opposite happens, then we do that. It's constant game planning and adjusting as we move along as price gives us new information. Here's a couple examples of that. For example, so this is the S&P 500. All right, so this goes back to into 2016 here. We talk about different market environments. We had this very nice uptrend in the S&P 500. Where we are now, we've had our correction. This is our 35% move in the S&P 500, and we've since rallied back up into this period, into this spot here. That is an important development as we head into this, what I'll call an orange box. And what I mean by that is, if you notice what's taken place in this orange box here, is we had the 2018 highs. Okay, in here we had the 2019 lows, and we tested those this box from different levels in 2019. And so this is a very important area. So we've rallied back up into this area. I will say that it's very important that we held the, this is the Christmas 2018 low. The fact that price got back above there is extremely important. And now we're at a point of decision. We've rallied up into this area where sellers have shown up in the past. Okay, we've have resistance up in this area. And so that's important. We need to have a game plan for what do we do if we move out of this box, we get pushed down to this box, we move sideways. And so the way I would describe this without it being a theological discussion is as long as we're above the 2018 lows, that's important. I would also say that as long as we're above this orange line in the box, which is about 27.25, it makes sense to have some exposure to stocks. We've had some exposure in stocks from this point into this box. Now, if we break back below out of this box, we don't need to be involved with stocks at that point. This would be an environment that's guilty. The stocks are guilty. If we break out of this box, that's another environment. We have a game plan for that. And this would be a more innocent type market that we can be involved in. As long as we remain in this box, we're going to call that purgatory. Again, it's not a theological discussion. The point is that you can have stocks move sideways in this range. It's about a 5 to 7% range for a while before picking a direction. So really, we're talking about an area that's on the high side. So the resistance meaning supply, where sellers have shown up before, is around this 28.75 area. The support where buyers have shown up before is around 27.25. In between here, we can have some exposure. Below here, we don't need to have any exposure. Above here, we can increase exposure. So that is called game planning. Again, this is not investment advice. If you're watching this and we don't know your investment tolerance and all sorts of things like that, you need to take this as education. This is also providing information to our clients. This is our game plan, one game plan using the S&P 500. Using zooming in again, this is zooming into an intraday period. So if we go back and look at this orange box, what I'm basically looking at is this area here. In this period, basically this whole section here, what does that look like? And it looks like this. That's this area right in here. And so we're inside that box now, and we want to be aware of, if price were to break lower, what action are we going to be taking? If it breaks higher, what action are we going to be taking? Another line in the sand would be between the 2600 and 2640 area, this shaded area in here. If stocks are below that, I would say that the odds dramatically increase that we're revisiting the lows near 2100, 2200 on the S&P 500, and the correction is back on. I'm not predicting that's what's happening, but I'm saying that for those of you listening or watching, that if we're below 2,600, then S&P 500, the odds increase of the correction unfolding further. As long as we're in this orange box between 27.25 and 28.75, that's perfectly normal digestion. If we break out of it to the upside, that's onward uptrend. And so those are the different things you can keep an eye on as you follow along. For the Russell 2000, this is one of the, small caps have been hurt pretty bad. Again, down over 40%. This is this is the Christmas 2018 low, and I wish I could draw extremely straight, but I'm not right now. But it would be very important for the Russell 2000 to get back above 125 to get, positive on stocks again. We're very much in between, a mixed phase, using that orange box from the previous S&P 500. The fact that the Russell 2000 is below the 2018 lows is important information, and we need to clear back above there. Otherwise, there is continued risk that we're going to see further downside in stocks. Nothing is guaranteed. If we use something like the All World Index that we've used in the past, you can see that that is above the 2018 lows. That's important information. As long as we stay above there, that's important. The next important line in the sand is this area here that you can see that price has interacted with on, we'll call it the 71 level. If we can get back above that, that would be very healthy. But it would also be very normal to have price move in a pretty large range here. That would be very frustrating for all market participants. Another area that is important is the Treasury market. Here I have Treasury or T-bond futures. So this is not TLT, the ETF. This is Treasury futures, and it's very important to note that price is sitting between 182 and 176-ish, and we could continue to end up in that range, okay, because we could be in a range-bound environment with Treasuries. Again, you can have a game plan for when we're moving out of that range and a game plan for when you're moving below that range. And that's what we do for our clients on an ongoing basis, is we have game plans for each market environment, up, down, or sideways, and we allocate accordingly. So we are running up against time. I know I've been talking and going through a lot of charts quickly, but we did receive some questions online and on whether our website or via email. We had someone ask, or a couple of people ask, what are your thoughts on dividends and preferred stocks? Someone mentioned we appear to be in a new normal. What are the prospects of the economy going forward? We had someone ask about oil going negative and how does that work? And we also had someone ask, who should the Packers and Chiefs draft? Important questions. And so before getting into oil, the thing I want to highlight about dividend stocks and preferred stocks is that if you go look up dividend stocks and preferred stocks, they are not immune from correction. For example, if we use an ETF like DVY, you can look this up yourself. So if we use an ETF like DVY for dividend stocks, and you look at how they performed during that correction, or an ETF like PFF, which represents preferred stocks, right? DVY was minus 41% during the correction, and PFF was minus 37. And so you have dividend stocks and preferred stocks that corrected quite a bit during the correction. So they also require adaptive management. And the thing about them is don't assume that a company is going to keep a dividend. Many companies cut their dividends in environments like this. So not only are you dealing with a minus 41% correction on your hands, but you're also dealing with a dividend getting cut, which is the exact reason why you held the stock in the first place. So that would be my comments on that. As far as the new normal, or what are the prospects of the economy going forward, let's dig into that a little bit. When we look at the data, now the first thing I want to highlight here is I'm not a doctor, I'm not a virologist, I'm not a epidemiologists. But we do have the ability to examine data. And so, if we talk about the new normal, quote unquote, the new normal, or what to expect with COVID, et cetera, a third of the COVID cases are coming out of New York, and we continue to see a decline in new hospitalizations, net of those being discharged for COVID out of New York. And so that's a very positive development. We're also noticing that, in the city of Chicago, we are not anywhere near using any capacity for ICU beds, which was a main concern. When we look in Wisconsin, we can see that we've got, this data is from a couple days ago, but about 361 total patients and 141 that are in ICU. That is a very low number of COVID patients. And so this new normal, it may be a normal that remains or it may not. And what I mean by that is if you think about the original safer at home orders, they were basically done under the pretense that we didn't really know exactly what was going on with this disease, with COVID, and what the death rate was. When we just look at those who are admitted to the ICU, the death rate increases. Now, the problem with that is, an analogy I could use is, if you're admitted to a hospital for a car accident and you die, what percentage of the deaths are related to car accidents? And so you see the trouble here. So if I'm admitted to the hospital for COVID and then I pass away, the death rate for COVID is pretty high. And so the shutdown and everything was based on this idea that a 2 or 3% death rate is pretty dramatic. So we're talking about deaths in the millions, which would be worthy of shutdown. But now we're starting to see data coming out based on antibody testing, showing that a greater amount of people had COVID and may have been asymptomatic, or they didn't, they might have symptoms, but they weren't dramatic enough to even require a hospital visit or even a call to the doctor. And when we consider that data, which continues to roll out, this is newer data now, that's starting to show that the death rate may actually be around 0.12 or 0.2, which is dramatically different than 2 to 3%. A 0.1% death rate is about like the flu. And again, I want to be very careful how I use that phrase, because it was a phrase that was probably overused at the beginning of this. The flu does not have a 2 or 3% death rate. That is a high death rate for a disease. If COVID actually has a death rate around 0.12 to 0.2, we don't have a new normal on our hands. We have an environment where we can reopen economies and be safe. And so there's antibody tests that are coming out that are suggesting that the coronavirus infections vastly exceeded official accounts. And what that means is the overall death rate drops in that scenario, in that formula. And so COVID may turn out to be this thing, and I hate to say this, we may look back on this and the risk, I would say the risk is now increasing that we are now in the boy who cried wolf type scenario. My new fear is that when we do have the disease that rolls around, that's a global killer, that we are going to have citizens across the world ignore it based on our response to COVID. So we'll see. We'll see what happens from this day forward. We continue to be very appreciative of all the healthcare workers that are helping. I will say, being married to a healthcare worker, that they're short on work. And so it's not like the healthcare system is overwhelmed right now. Far from it. Actually, from states that are outside New York or even New York, we're seeing a decrease in hospitalizations. I don't want to diminish what's going on with COVID, but I can tell you that based on anecdotal and data that we're looking at, that our healthcare system is not overwhelmed by COVID. We hope it remains that way. Maybe the preventative measures allowed for that, or maybe the incidence of COVID infection was actually much, much greater and entered our country much, much earlier than many people thought. And so then the concern becomes that there was an overreaction. But we'll see. The data will provide that insight. So that's my thoughts on the COVID situation. As far as oil, someone mentioned oil going negative. That's exactly what did happen a few days ago. Is for the first time ever, we had the May oil futures contract trade negative, which basically means that someone, if you want to take physical delivery of oil, they would have to pay you. You'd have to drive down to Cushing, Oklahoma, provide your receipt for the May contract. They would give you your barrels of oil and some cash. And the reason why this is happening is we have now plenty of oil supply. You can get into all what, have your own opinions about Saudi Arabia and et cetera, et cetera. You can buy me a drink and we can have that discussion much more in depth. But there, on the other side of this is the rent rates for tankers and storage units is through the roof. It's because those units are full of oil. And so there's no place to put the oil. And that's why you're seeing negative contracts for oil. Will that continue? We don't know, but it is something that's possible. Many in the commodity space would say, oh, you should own commodities because they can't go bankrupt like a company can. Well, the contracts can go negative, and it's par for 2020. It's another historical thing for this year, being able to trade oil at a negative price. So it did happen. What is the prospects for the future? Well, obviously, if we want to see increased demand economically, that would cause the price of oil to increase. Most likely, this price of oil is driving a lot of rigs and different drilling offline. And we may see a lower price of oil continuing here for the foreseeable future. But we'll see. Price knows best, and we'll manage accordingly. Getting into who the Packers and Chiefs should draft. I think I'm going to go with two TCU Horned Frogs here. I'm going to go with the Packers should take a guy like Jalen Reagor, runs like a 4.3 40. Would look good in the slot, in the Randall Cobb spot with Aaron Rodgers, the human hiccup. I think that would be a great pick. I don't know if he'll last that long, or maybe he'll go in the second round. I have no idea. Again, we won't know until the draft tomorrow. The Chiefs probably should reload on defense. I know they're losing Fuller, I believe, and Jeff Gladney, guy high points the ball, plays the ball, be a great addition. This guy over here can return punts as well, and this guy would be probably be able to start on day one. So I'm going to take two TCU players here for the Packers and Chiefs. And so my final thoughts, wrapping it up since we're bumping up against time, is that I do believe we're going to come out on the other side of this in a much stronger position. We understand that there's a lot of challenges. I'm looking forward to when I can see all of you in person again. I'm really excited for that. And I know these are tough times, but we are seeing American ingenuity at its finest. And we're going to look back 12 months from now. And this is going to be quite an experiment that we went through, quite a trial that we went through, that we're going to come out stronger in the end from. And so we want to stay focused on price regardless of headline news or drama that's going on politically. We're going to stay focused. And so we're going to, for us and for our clients and working in their best interest, we're going to stay adaptive. We're always going to identify risk and reward. We're going to invest with the direction of the trend. We're going to manage risk using weight of evidence and position sizing. We're going to stay disciplined to the system and the hard data. So that's, in the end, that's what we're going to do for our clients. If you're interested in that, you can contact us. Next month, Justin and the tax team are going to talk about tax case studies and tax strategy. That may be changing because I know we've had an extension with the tax deadline. And regarding that, we are accepting tax intakes through June 16th. With the July 15th deadline, we are accepting tax intakes through June 16th. It's $79 for those that are 50 and over, 49 and below. It's $149. And if you want to, and you're interested, reach out to us, 262-335-1700, or email us at myteam@clientfirsttaxandwealth.com. If you're interested in an initial consultation, we make it really simple. This is our stress-free way to do business with us. Step one, you just schedule a no-fee initial consultation. You work with your Client First team to customize a true holistic plan for you. Ongoing, you receive strategy updates as your life changes, and you enjoy your new financial confidence. To do that, simply call 262-335-1700 or email us at myteam@clientfirsttaxandwealth.com. We hope you enjoyed this presentation and found it insightful. We enjoy helping people secure the financial confidence they deserve. As always, these presentations are for informational and educational purposes only. I look forward to seeing you guys again. If you have any questions, please reach out to me at your earliest convenience, and I'll do my best to answer them. Otherwise, Lord willing, I'll see you at the next Lunch and Learn in person in July. Take care, everyone.